All right, so this market sell-off worsening so far today after yesterday. We saw key support levels really fall apart on the S&P 500. At this point, you wonder just how low can it go. So let's go to Chart School and bring in one of my favorites, Market Gauge Managing Director Michelle Snyder. Michelle, we did find some support today, a little bit of support, right? Some would say maybe 3,700 is a key number, but this seems to be the 200-week moving average seems to be what a lot of people are looking at. Do you think that will hold? And if it doesn't, how vulnerable would we be?
Well, first of all, in terms of the 200-week, if we look at the Russell 2000 as any kind of lead indicator, it's already broken the 200-week. So that means projecting ahead, we have to assume that the S&P will at least get to its 200-week. So the question is what happens from there. People keep looking for some kind of bounce, and these bounces are getting shallower and shallower. Unfortunately, that's not really a good sign. If we break first of all, if we hold around here and get back to 380, it may be a while till we see 350. But if we do break, and of course tomorrow is going to be so key, then we'll look at that 350. But what's interesting about it is that everyone will expect this great crash. But at 340, we're right at the pandemic high before we started taking off.
Right.
So it could be support all the way down. This does not necessarily have to be the huge crash based on the charts that people are anticipating. It would be more like a slow burn, rallies here and there, and then new levels being formed and new trading ranges.
So, yeah, I guess, though, it's the most important thing. A lot of folks are just wondering, how far down because it doesn't look like on the charts there's a lot of support. I mean, you're sort of grasping for straws. Now, on the other hand, if we look at this in terms of recent history, in terms of the drawdown so far, it's getting pretty big. Coming into today, more than 21% on the S&P. The only times it was bigger than this, that big spike, of course, for the pandemic. And then that was in December after Jay Powell hiked rates 4 times. I mean, and one thing with both of these, we came back very, very quickly there. So at what point does this, do you see this making a difference? Does it all matter whether or not we have a recession or not?
Well, we're in stagflation, and that could last for a really long time before we actually see an official recession. Because remember, Charles, this is such a unique time. We came out of COVID where we were at a standstill. So we've come back from there, but not very strong. It was more like the back to normal type of scenario. So that means a recession would really have to mean that we'd get almost worse off than we were during the pandemic. I'm not so sure that's going to happen at this point. To me, I think the biggest problem that we have going forward in terms of people looking for some kind of bounce other than a bear market rally is that the Fed policy has completely shifted. After 13 years of accommodation, we are in QT. We will stay in QT. Of course, how aggressive they are will make a difference more immediately. Can they drive us into a recession? Absolutely. But right now, I'm one of the few who thinks 50 basis points tomorrow, not more than that.
Really? Okay, real quick then, because I'm running out of time. So people, and it sounds like you're suggesting people are going to have to learn how to trade the market but it will be a market that's making a series of maybe lower lows, lower highs until the Fed pivots, and that could be a long time from now.
Absolutely. And one other thing before we don't have any more time is you got to look at the retail sector right now. Yeah. XRT, very interesting.
I have it on the screen right now. Looks like another one of these charts that's at the moment of truth. We'll see just how much money people are sitting on. Wall Street says $2.5 trillion. I say that's bunk. Thanks a lot, Michelle. Always appreciate it. All right.